vibration that lets success soar high. I will achieve, I will fly high. In SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Indian banks are warning their customers against a Trojan virus. The SOVA virus, now estimated to be upgraded for the fifth time, can record logins and steal money. In certain cases, it can also act as a ransomware and block customers from accessing their phones. However, this is not the first time hackers have tried to steal information. Last year, Indian users were warned against Android malware Drinic, which could also steal banking data. As banks unveil more digital products, they will also need to spend money on IT services and customer literacy. I'm Ishan Gera and you're watching the Business Standard Banking Show. In today's episode, we shall discuss significant banking developments, including the rupee's decline and RBI's upcoming MPC meeting. We have an interview lined up with Tata Capital MD and CEO Rajiv Sabharwal. Our Banking for You section explains ASBA, and the panel comprising banking expert Tamal Bandyopadhyay and Bank of Baroda Chief Economist Madan Sabnavis discuss the upcoming RBI MPC meeting. At the end of our episode, we shall discuss the results of our last poll and ask you the question for the next week. So stay tuned. Last week, the Federal Reserve raised the Fed funds rate by 75 basis points. The decision followed ECB's decision a fortnight ago to raise rates by a similar quantum. While India is not expected to raise rates by as much, the discussion on rate hikes has shifted from 25 basis point to 35 or 50 basis point hike. Rupee breaching the 81 to a dollar level has not helped matters. Neither has the fact that the inflation reading for August was above 7%. The only relief India has is the fall in commodity prices. RBI's GDP growth and inflation expectations will be closely monitored for future signals. When the RBI governor announced the first rate hike in May, he also focused on absorbing liquidity from the system. RBI has finally been able to achieve that, as reports indicate that there is a liquidity deficit of 21,873 crore rupees. Reports indicate that RBI may announce open market operations and variable repo auctions on September 30th to bridge the deficit that had arisen after nearly 4 years. Even if the liquidity deficit were to be bridged, many expect the deficit to continue into the festival season as people withdraw cash. Moreover, deposit growth lagging in credit growth is another problem that would need to be addressed. Credit growth at 16.2% year-on-year for the week ending September 9th was the highest in nearly a decade. The last time credit growth had touched 16% was in November 2013. Deposits, on the other hand, grew by 9.5% during the same period. Meanwhile, the insurance sector is expected to witness more changes. After a flurry of proposals from RBI to ease norms, insurance companies are attracting interest. Reports indicate that Piramal and Zurich Insurance are mulling a joint bid for Reliance's general insurance arm. The bid, if successful, shall mark the entry of a Switzerland-based insurer into India's general insurance sector. The government is also looking to privatize one of India's 4 general insurers. Non-banking financial companies are also experiencing stellar growth along with banks. As they emerge from the pandemic slump, NBFCs are also witnessing credit growth. In a conversation with Business Standard's Raghu Mohan, Rajiv Sabharwal, MD and CEO of Tata Capital, discusses the outlook for the NBFC sector and the company's performance.
Hi Rajiv, good to hear you on the BS Banking Show. NBFCs appear to be on a better track at this point in time. What is your sense of the business? Can you please elaborate on this?
First of all, thank you, Raghu. It's always a pleasure talking to you. And when you talk about the NBFC sector, I think we are a part of the whole ecosystem. The way you're seeing India on a strong trajectory of growth at this point of time, I think we all are riding on that growth. Whether it's the banks or the NBFCs, we are riding on that growth. With the credit growing at closer to about 12% as expected this year, We believe that the NBFC sector should be growing at a pace which is better than this. And we're seeing this growth happening across sectors, largely on the retail side. There has been a pickup on the MSME side and on the working capital side. Uh, we still believe that it's, the whole space on the corporate side in terms of more investments have to still pick up. But on the other sectors, we are seeing good growth happening across industries.
Rajiv, despite corporate results being good, we are yet to see capacity expansion kick in a big way. What explains this?
Actually, the last numbers which I saw, capacity utilization has been picking up, and now actually it did cross 75% for most of the sectors. The GST collections is also shown a similar trend. Uh, and that's more because of the fact that we have a large domestic economy and things post-COVID have opened up completely. So the capacity utilizations have gone up. In fact, in the corporate lending segment, largely the loans are on floating rate. Almost all the loans on this, for the corporate segment are on floating rate. So the impact of rate increase may be marginal there because most of the impact will get passed on to the final customers.
What explains the buoyancy in retail credit, even as we are yet to fully recover from the effects of the pandemic? Plus, job data has still some way to go.
Raghu, you're right. When you look at the period when COVID was there, a lot of people lost their jobs. And people who, some of them who didn't lose their jobs, did have their salaries getting impacted. Especially this happened for those employees who were in those industries, which were high contact industries and where the impact of the pandemic was more, whether it was travel, tourism, airlines, and so on, or schools and buses and some of these segments. But as the economy opened up, these people not only got their jobs, but in most of the cases, people are back to pre-pandemic salaries too. Uh, in fact, there are a lot of people who tell us in those industries that it is difficult to find people to work with, who can join them and take it forward. It's a problem with the tourism industry. It's that issue remains. And the other day I was reading in US, it's also an issue with school teachers. So in fact, we have moved to the other extreme where there is a requirement of more people to come into those industries. So with the salaries, coming back, with more people getting jobs, we are seeing, demand coming back. Part of it could also be because of pent up demand, which is there, for example, in the passenger vehicle segment where there are bookings. Who could have imagined there are, for buying a car, you could have 6 months of waiting period or more. So some of those things are there also, but if you look at data, it tells you that in most of the industries, while the growth is very good, you are now just about crossing the same level of business as you had at the pre-pandemic times. So it's a revival of those things, plus the fact that there are the overall growth which is happening in the market as we are seeing on GDP. Though, so all of this is leading to a situation where we are seeing credit growth in the markets. We should remember that some of the growth which we are talking about, for example, in Q1 is over a smaller base of last Q1, which had got impacted.
Yes.
So, but if you look at the pre-pandemic numbers, we are just about ahead of them. So it's also because of the fact of low base that we are seeing this growth.
Can you give us a sense of the cross-selling strategy Tata Capital has vis-a-vis other Tata Group companies?
I think what is important for us to look at is which are the areas in which we can look at deriving synergies within the group. So we can't be direct lenders because they are limitations of what we can lend, because if we lend more than a particular amount, then that impacts our capital adequacy ratio. So we are not we don't lend directly to the group in terms of large quantums. We can't. I think what we are trying to focus on is there is a large base of employees within the group.
Yeah.
Can we cross-sell more retail loans to them? There are a lot of people who are suppliers and vendors of large companies within the group. Can we be financial partners to them for lending? It could be for working capital or term loans. So it's more of the ecosystem lending which we do. Similarly, TCS it's a great company on the technology side. How can they support us on our tech platforms? So some of those synergies we look at in terms of working together. And so on lending side, it is more to do with the ecosystem. And as far as direct is concerned, that's a very, very small proportion. We don't have a large book in terms of lending directly to the group.
Thank you, Rajiv, for giving your time on the BS Banking Show. Looking forward to having you again sometime later. Have a good day.
Thank you so much, Raghu. Thank you so much. And you too have a nice day.
Sabharwal says NBFCs and banks are riding the growth tide. He also says there's a pickup on the MSME and the working capital side. Meanwhile, SEBI is trying to introduce changes on the trading side. 14 years after it introduced the ASBA payment system for IPO applications, it is looking to introduce it to the secondary market. In our Banking for You section, experts explain what ASBA is.
Soon there will be an ASBA-like payment mechanism for secondary market trading too. SEBI chairperson Madhavi Puri Butch made this announcement on Wednesday while saying that it will be rolled out in the next few months. Applications supported by blocked amount, or ASBA as it is known in common parlance, will do away with the cumbersome process of moving funds back and forth between their banking account and that of the broker. But what is ASBA? Introduced in 2008, ASBA is a payment system used for IPO applications. Earlier, investors had to submit checks or transfer money online from their account to an escrow account formed for an IPO while making an application. The money used to move out of an investor's bank account irrespective of whether he or she got an allotment. After ASBA, this process changed. Now, the money only remains blocked in an investor's bank account at the time of subscribing for an IPO. It is deducted only if the shares are allotted. In case of no allotment, the entire amount gets unblocked. In recent years, there have been several instances of brokers misusing investors' securities. Brokers were able to access their clients' securities through a power of attorney they obtained while opening a trading account. They also gained access to securities pledged by clients as collateral. There are also instances of brokers not returning idle funds lying with them after 30 days or 90 days as mandated by SEBI. Brokers earn a float on investor money lying with them. After the ASBA-like system is implemented for the secondary market, investors will be able to place orders by merely ensuring they have adequate funds in their bank account. Like IPOs, the money will move out only when trades get confirmed. It will ensure that brokers also don't get access to the investors' funds. According to experts, there might be instances of blocking and unblocking money for the multiple trades a customer makes in a day. Also, even in ASBA, there might be issues like failure rates and more time taken for blocking.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Applications supported by blocked amount, or ASBA as it is known in the common parlance, will do away with the cumbersome process of moving funds back and forth between their banking account and that of the broker. Changes may also abound for banks as the central bank decides on the future trajectory of rates in its Friday meeting. Our panel, comprising our consulting editor Tamal Bandyopadhyay and Bank of Baroda Chief Economist Madan Sabnavis, discussed their forecast for the RBI meeting and the future trajectory of rates. Hello, welcome to the Business Standard Banking Show. Tamal and Madan, thanks for coming on the show. Tamal, I'll start with you. In your column this week, you explained the reasons for both the 50 basis point and 35 basis point hike in the coming meeting. What is your take? Has your forecast changed from the 35 basis point you were expecting earlier?
I would stick to 50 bips. In fact, I would not be hugely surprised if RBI goes for even 60 bips and make it rounded figure 6%, provided RBI decides to give a forecast, the way ahead very clearly that we have reached a milestone and now change the policy stance from neutral. Now from here it can go either way. And the reasons are fairly simple. While inflation will definitely be within the RBI estimate, and the big positive point is the crude price going down. But the bigger elephant in the room is currency depreciation.
Now, Madan, I've been reading your reports. The last few focused on currency and T-bill yields. What are your expectations of a rate hike, and would RBI change its stance from accommodative?
Actually, Ishan, before the Federal Reserve came up with a policy, I would have pitched for a 25 or a 35 basis points increase in interest rates. But now, given the fact that the Federal Reserve has given a rather aggressive future outlook, and the fact that there has been reverberations in the currency market, I would now change my stance and say that, look, the RBI would probably go in for a 50 basis points increase in interest rates. Now, in terms of the stance, I think definitely there would be a change because they were talking of withdrawal of accommodation, which probably is not really relevant today because we are already in the situation of maybe sometimes a deficit liquidity. But I think the stance will probably be changed to neutral.
Would you go as far as saying it can go above 50 basis point, as Tamal pointed out?
So probably not in this particular policy, but earlier we felt that maybe the terminal point could be 6. But now today, if you look at the OIS rates, the 1-year rates for the 9 months down, it looks as if it could be over 6.5%. So we could probably be thinking of another 25 basis points increase.
Tamal, coming back to you, one of the interesting aspects that I found in your column this week was the estimate for the growth. You said RBI may revise its estimate downward from 7.2%. Do you expect inflation estimates to remain the same given what has been happening? Can you explain your rationale for that?
No, inflation, I would like to believe RBI would not change it. Whatever advantage we are getting out of crude prices coming down has been largely offset by food inflation, rising food inflation, and also because of currency depreciation, imported inflation. As far as growth is concerned, 7.2 has been RBI growth, and you see everybody and his uncle has been cutting the growth rate. All multilateral agencies, global raters. So I'll not be surprised if RBI brings it down to 7%.
So I don't really think that prices are going to come down. I mean, prices will continue to increase. Yes, a statistical effect could probably ensure that the numbers could at times come closer towards 6%, other times around 7%. But I think 6.5% to 7% range of inflation is something which we could expect for the rest of the year. And intrinsically, I think an economy like India is one which would always inflation above 5.5%.
Now, as we were discussing this, one of the things that has happened is that rupee has slipped below 81. Right. Are we looking at 82 or 83 as the new normal? And can RBI keep on selling dollars to protect the rupee? What do you think, Tama?
Well, first question is, what's the big deal about 80? I don't understand. Why you were so obsessed with the... I can imagine I would not love to cross 80 because I'll be tottering old man. But for a currency, you have to respect the market. I mean, this is not a reflection of Indian economy. Rupee is depreciating on a depreciation mode because of US dollar is gaining strength. If you look at Reserve Bank of India monthly bulletin, in the last monthly bulletin, the state of economy talks about rupee. The current currency reserve is equal to 9 months import, which was much higher in the past. I mean, in the recent past.
Yeah.
So I think it's good to allow rupee to find its own level. What will be the ideal level? Nobody knows. But I would like to believe it will be anywhere between 80 and 82 over the next few months.
Madan, Tamal raised a very interesting point about the import cover. How much of an import cover can we afford at this time?
If we're talking of an import cover, I think there is some thumb rule which says that 4 months, anything less than 4 months is dangerous. Anything above that is good. At one time we had 12, 14 months. Now probably it's 7, 8 months. But actually, I would like to respond to what Tamal said, what's so sacrosanct about 80. Because unfortunately, the way the market behaves is that they always have these marks saying, 79 for a long time was considered to be a psychological mark and it became 80. Now it's 81, it's 82. But I say it's a market sentiment. I mean, there's no rationale for it. It could also be 90, it could be 80, but that's how it goes. Now, the situation has actually changed significantly in the last 6 months. Second, if you look at the fundamentals, I think they have been weakening. I think the critical role will be as to what the RBI does. Now, as Tamal said that, okay, $90 billion have already been spent. How much more can we keep dipping into our forex kitty continuously? But this, I think, is a tough call for the central bank. And I think it's not a nice position. Because if the central bank doesn't do anything, the market assumes that the RBI is happy with 81, it'll go down to 82. Because if I'm an exporter, I feel that it could go to 83, so let me not bring back my earnings. If I'm an importer, I'm going to be panicky, I'm going to rush into the market, and this itself will exacerbate the demand and supply for dollars, and that will drive the rupee downwards. So to my mind, we have crossed 81. I think 81 seems to be fairly acceptable to the RBI, so there won't be too much of intervention.
Thank you. Thanks a lot, gentlemen, for being on the show. We hope to have you back again soon. Thank you.
Pleasure being here.
Tamal and Madan both agree on a 50 basis point rate hike for this meeting. Last week, we asked you about the rate hike you expect from the RBI meeting. BS poll had projected a rate hike of 50 basis points, and our viewers concur. Results indicate that 59% of the people in our poll expect RBI to raise rates by over 35 basis points. That's less confidence than our experts, though, on rate hikes. Rates in either case are expected to cross the 6% mark in December as RBI plays catch-up with global central banks. This week, we would like to know if RBI's decision on rates was aggressive or not. After RBI's rate decision, our polls will open on Friday and you can respond on Twitter, Instagram, Telegram, LinkedIn and our website. We'll be back next week with our next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.